All right, I think we are good to go. I'll just go ahead and start sharing my screen. But before then, I want to welcome every one of you live on YouTube. I want to also welcome those of you live in the room with me here on the special VIP Zoom call studio room. Permit me to use that word. And today is the 16th day of our training. We started this training from day 1. Day 2, we were here. Day 3, it was back to back until today. We now are here on day 16. Here today on day 16, we'll be discussing the topic, how to trade with high probability chart patterns. And I'm going to go slowly and steady to ensure that even a beginner with zero experience, who knows nothing about this market, at the end of this class, a beginner should be able to identify chart patterns. That's the least of what I expect in the next 40 minutes that we are here. And let me not also forget to say that this is only one of the class that is required for you to be a professional trader. We still have several other classes ahead of us. Tomorrow's class, day 17. Then Monday class, Saturday is day 18, Sunday is day 19, but we will not have these private classes. But then on Monday, we have 18, 19, day 20th. Until we get to day 30, we'll be having several classes that every trader would need to participate on or in, if you like, so that we can say that you understand what you are doing. You will not just pick a particular topic in isolation and begin to run with it that you've understood the market. It doesn't work like that. A little here, a little there, until you get everything put together, form a niche for yourself, and start enjoying all that it is to enjoy as far as this market is concerned. And while that is being said, it's important for me to maybe a little bit of revision, or how we put it now. Previous classes, we talked about how to analyze the markets. Then the class before, the last class we had last year, that's the last class for 2024, we talked about how to enter a trade, entry strategy. All these videos are on my YouTube, James Ochima. If you click on the subscription button, you will get subsequent video. If you hit like and go to the comment section and interact, we'll be able to get closer to each other. But there are several other videos you can still watch to bring you up to speed. Some of the things I would skip are stuff I've said in previous classes. And some of the things I will skip are stuff I will say later. So you have to join the subscription button on the YouTube for free access to get all these materials, right? I also said some of the basic things I will not go detail to explain are stuff that you can access by yourself from this free website. Many years ago, when I started my journey, over 8 years plus in this market, I started from this website. And up to today, this website has not changed. There is no new chart pattern in the market. There is no new anything in this market. It has always been one and the same. From before I was born, long after I'm gone, it will still be there. The same. Nothing new under the sun. So you need to go to this website, access this website. Under the area where they say Learn Forex, you will see the School of Pipsology. Learn Forex, School of Pipsology, start learning. They would ask you to register. It's free. Go ahead and register. And in one of the classes, I was emphasizing that this area of study is, permit me to say, a place where we do free, no, not free. The word there is self-discovery. You need to discover yourself. What type of trader are you? What style of trading are you doing? What are the details involved in the thing you are trading or in your style of trading? You need to come here, find time, and deal with this course. It's a free area. Now, I also warn you that this course or this Mixology is very, very bulky. Not just bulky, it's boring. So if you are not ready for a lot of work, you can't finish what you have here. And if you cannot finish what you have here, you still have a long way to go in this industry. So from the kindergarten level where you have definition of terms, what is Forex, what is this, Forex brokers, types of analysis, types of charts, support and resistance, Japanese candlestick, Fibonacci, moving average, popular chart indicators, oscillators, important chart patterns. So we are going to be running through with important charts patterns. There are so many of them that I said that these chart patterns, we'll be discussing about them later. They are called advanced chart patterns. But there are the basic ones that everybody must know, because this one, they are almost everywhere in the market, and every time they are always there doing a lot of things. Before we go fully into chart patterns, yesterday or 2 days ago rather, 31st of December, we called a trade on Move USDT. And if you were here with me on that call when we started that particular asset, when we saw that position was from H4 time frame, if you remember. We were here on Move USD on H4 time frame. If you remember very, very clearly when we called this position on 4 hours time frame, after we had drawn this line on weekly time frame, don't ask me how, we already treated that. It's called mapping. And this other one from weekly time frame, don't ask me how we got that line. It was from weekly time frame. If you go to weekly and daily, you will see how we draw that line. So, but what we saw that day was this particular green candle. So that one, we call it the bullish engulfing. And after we drew that bullish engulfing, we said that now the price has hit the support and formed a bullish engulfing. Now H4 has indicated to us that it is time for us to go up. But we must wait for price to drop down into a discount level. And for us to wait for price to drop down into a discount level, the process is called entry strategy. We need to come down to a lower time frame like M30 or M15 to wait for price to drop down into a lower level. So that was what brought us to the other class. And we say for the purpose of understanding, this drop and this rise was the H4 bullish engulfing that we saw there. It's this rise that gave us that bullish engulfing. But we need the price to drop down after the bullish engulfing to a discount level. So if the price drops down to discount level, we also said that it can give us signal at any point. Sometimes after the bullish engulfing, a little bit push downward, it will give us signal and begin to go up. So when we take note of signals, we will be looking at entry strategy. Sometimes you may not see the signal from M30, you may see it on M15. Sometimes you may not see it on M15, you may see it on M30, which is why you have to be good at changing time frame to search for something. M15, M30, you are looking for entry signals. H4, you know the direction where you are going already. D1, week 1, you know general market flow. Where are we going? H4, we are looking for the structure, chart patterns, supply and demand. M30, M15, 15, we keep looking for chart patterns, entry strategy, candle analysis. Most important is the entry. So what we did 2 days ago was to bring it down to M15 to identify, to still remember that this is the bullish engulfing that tell us we are going up, but we need the price to pull down to discount level. So if the price begin to pull down, I remember clearly I show you that this 3 sign, 1, 2, 3, is a good pattern in the market called morning star. But the morning star supposed to be that the green candle is taller than the remaining 2 candles, the smaller one and the red one. Then that is a proper morning star. The next candle we enter a buy, we are going all the way up. But in a situation whereby the morning star is not an ogbonge morning star, it is not absolutely clear and complete, that is showing that something is wrong somewhere. So even if you enter here, it will pull you back. In most cases, sometimes it can go. So I remember saying in that call that some people enter this trade from here, this particular candle. After the morning star is their entry signal, so they enter the next candle. What happened to them? Price goes to neckline. Neckline is the last place that price formed during that bullish engulfing. So we need to see that price breaks the neckline, then pull back and never ever come back to close below this low. Then that means we are good to go. We are off. We need to see those 2 things after we enter. If we make our entry, we need to see price break the neckline that gave us the reason to enter, then pull back, then continue. That is all we have gone. So when we entered from here, supposedly the price never broke the neckline. The price came down. When it came down, it formed a sell side liquidity sweep. What is SSL? It means that it came down, it swept this place that's supposed to be our new low that will take off. That did not take off. It swept it off. And the process of sweeping that is called sell side liquidity. A lot of stop loss were under here. It came to take it off. Or in another way, because this is crypto, we can simply say it came to look for more buyers, bring down more discounts. So many traders, when they see this pin bar, they will enter the next candle. So the pin bar now is another reason why many traders will enter. It's an entry signal. So you have seen the H4 bullish engulfing. You have seen the pullback, giving you a signal of a pin bar candle. The next candle is your entry. Then I also said I am not a lover of pin bar because pin bar is mostly used by market makers to manipulate buyers and sellers. So pin bar alone cannot make me decide to enter. So I now said that if you see the pin bar and you did not enter, another very important thing some other traders do is to look left. If you look leftward, you'll be looking for any of the institutional reference points. One of them is breaker block, like this one we have here. It's a breaker block. This price moved up, came down, and broke. It's called a breaker block. When price visit it and hit on it, it's used for limit order. My friend Wisdom Ariko, I can remember I said, that's the kind of entry he likes, limit order. So another institutional reference point is order block. So I did not see any strong, solid order block here. I can only call this particular green candle the order block because after this candle, the pullback candle, the next thing we saw was a massive push that broke this area here. So this candle, this green one, is our order block candle, this place. So some traders can choose the order block as their limit order. So if they have the price go up, they'll just come down here and set on institutional reference for a breaker block, order block. They'll set their entry as a limit order entry, and then they go. That is about entry strategy instead of using a pin bar. So they will focus on order block, fair value gap, breaker block instead of the pin bar. Then if you miss this entry and price did not go, the next thing price dumped again on this pin bar. But price failed to break below the order block. The order block is here. It not also break below the breaker block. It just only tested it and created rejection. And then formed something that looked like a morning star again. and somebody say, no, James, this is not a morning star because the green candle did not go above the red candle, that a morning star is a morning star is a 3-candle pattern. So, but the green candle, which should form the end of the morning star, this thing I'm always calling morning star. What is morning star candle? Phone is not charging, William. Please, you have to stop playing it. Sorry, please. I think I have an obstruction. Somebody is obstructing my direct line. Let's see. All right. So that's morning star. Morning star candle, I'm correct. You see the way it's designed? 1, 2, 3. It's a 3-candle pattern. You see the way it's designed here? 1, 2, 3. It's a 3-candle pattern. See the way it's designed? 1, 2, 3. It's a 3-candle pattern. You see this one? This is the ideal morning star that I prefer. 1, 2, 3. Where the third candle that formed the move is higher than the red one. I don't care about this middle candle, but this red one, I always like it to be higher than this green one, the third green one that is the main move. I prefer it to be higher than this other one. That is, after this one, then I enter on the next candle. So that's the morning star candle pattern. Morning star pattern. 3 bullish trend reversal pattern, 3-candle pattern. The first candle is red. The second candle can be any color, but it should be a doji or spinning top, which suggests indecision. Then the third candle is a green bullish candle. It's more effective when backed up with a higher volume. That's what I just said now. Read more at Livestock Trading, blah, blah. So if the third one is showing enough volume inside it, it means that morning star is a powerful or highly effective one, like I just said here right now. So I think I'm correct, and I can continue what I was saying. So we also said that once the morning star is formed, somebody say it's not a morning star. So I now say, okay, if it's not a morning star, I agree. This green candle and this red candle, the two of them form bullish engulfing. So in that case, our entry is the next candle. How many of you remember I said so? That in that case, our entry is the next candle. And I also say at this point that the person that entered from here, the person that entered from here, the person that entered from here, the person that enters from here, all of them are correct. The most correct of all of them is the one that entered from here because he's entering at OTE. How many of you remember I said that? Optimal trade entry. Also meaning that if the price goes down and closes below this low, after your entry, price closes below this low, which is a weekly low, it means that price has changed direction. It's called break of structure. And if we have a pullback seconded by a bearish engulfing, it means we are heading downward. So you have to exit your trade and change the position of your trade if you are very aggressive and you feel you must trade by fire by force. Otherwise, you accept your loss, pack your bags, and go home. Look for another trade. So we said that invalidates that position already on your not on M30 and M15. No. This has to be clear. The breakout must be clear with H4 candle. A H4 candle breakout is something you want to pay more attention to, not the M15 one or M30. It can be a fake out. Even that of the H4 can still be a fake out if there is a breakout and the next candle encroach back into the zone and show you a bullish engulfing inside the zone upward. So it will be a breakout and then the candle comes back in, and after it comes back in like this, then there is a pullback to the zone again. Then there is a bullish engulfing. Then the next thing you will notice is that the price will take off all the way to the top side. after closing below the weekly line. It's possible for price to go back in, pull back, and move up. Usually when price does this, you will see something called a BPR, balanced price range. The ratio, I mean balanced price range, whichever one. So we'll teach about the BPR later. So maybe in one of our classes, we'll teach about the institutional reference points, about 7 of them from ICT and smart money concepts. So we can get to see, but all of those things are subject to the basic thing we are teaching you right now, the supply and demand, resistance and support. They are all subject to all these things we are teaching you and these candle patterns. They are only called advanced because they are new ways of looking at the market, new ways of looking at old things. Doesn't really change anything, but it only brings more clarity. All right, and it creates more confidence in your trading, right? And also supports your risk management. So I remember we said all of those things. Then we executed the trade. When we executed the trade began to move. Then we saw a bullish engulfing, which is also a sign of morning star here. That increased our confidence level. We went up, we came down, we saw another massive bullish engulfing, which further increased our confidence, telling us we are going up. Then we came down again. Then we see another bullish engulfing again. Several times, the market is showing us signs that we are going up. And in all the time, the price was never coming to break this support, never coming to even break this area, never coming to test this area again. It's all signal telling us we are going up. So wise traders jumped in from here. We pulled up again, tested this high. At that point, I now start giving up. Like, is this price going to go or not? I took some profit when it got here. I took some profit because it's the third time it's coming to that neckline. The first time he created the neckline, the second time he came there, the third time he came there, he couldn't break it. So, but then when a price continues to test that level, it's possible that price can reject and come down. It's possible that price can gather energy and go break the level. What happened? Price came back again a little bit, have another bullish engulfing. This time around, when I saw this bullish engulfing, I knew that this is the time they are going to break, because they are setting up a bullish engulfing, which is a higher high. It was creating a high here, a higher high, a higher high, another higher high, bullish engulfing. I knew before it happened that they were going to break it. The next thing we saw was application sign. Another bullish engulfing here, 1, 2, break and close above M15. Another strong break. If you go to M30, you will see the break is obvious. They broke the neckline successfully. Remember what I said? After the break of the neckline, there will be a pullback. Take your profit first. That was where we took the first profits. After the neckline was broken, we took the profits. So when the market does this, take your profits, because there's going to be a pullback. Sometimes the pullback is minimal, 1, 2, 3, and then move up again. Sometimes it can come down here and move up from here. Sometimes it can come so low, the same range with this one, and move up from here. Sometimes it can come down to the same height where you started from your stop loss before it moves on. In this case, it came right to the stop loss area. If you didn't enter the trade, it has taken you out after giving you TP. So I took profit here, I took profit here. The price came back again. I knew that we were going to go high again. But this time around, I wanted to see reason to go high, because it's coming to where I don't expect it to come to. So this first move was not a good reason. I didn't enter. The second time it came again, I knew there was a trade here because it formed a chart pattern. I will show you the chart pattern. So there was actually a trade here after this bullish engulf, which was this one. And it went up to create a neckline. So some people took profit. I was not part of it. Okay, this was one I entered. I beg your pardon, sorry. I didn't draw it, but this was the one I entered. After this one, I entered this one. This was the last one I called that I put on my, what's it called? I put on my MEXC exchange. So you will see one, I have 2 trades. One of them I put on BingX. If you check the trader channel, you will see the one on BingX. I made 60% in profit. Then the one on MEXC, I made 204% in profits. So that is that second position. It was when it came here for the second time. When it came here for the second time, I jumped into the trade. Then it went up, created a neckline. It came down, tested the same region again. That was the final time we saw it. It was called triple bottom, 1, 2, 3. And then we moved up all the way up, broke the neckline here. This neckline, this one was broken here. After the break, it pulled back a little bit, bullish engulfing, pull back a little bit, morning star, and we shoot up the way to take profit. So after the break of the neckline, you see the push that went up, we have to take profits. If we don't take profit, there will be a pullback. Where will this pullback stop? That's a story for another analysis. So it means we have to measure this neckline and make it our new trading range. And we will now begin to judge the market based on what is happening here. We'll judge the market based on what is happening here and say, okay, if we are going to be going up from here, and this is going to be our new support. So if we mark this as our new support, our trading range, then our first target, our first profit target will be the new resistance, which will be this one. So we're trading from here to here. That's what we are trading. So if we are trading from here to here, the best entry will be a test of this region. So we want the price to come down, test any of this one is gone. We're done with this one, so we can leave it alone. So we want the price to come down and test this level for the second time. We want to see how price will come and test this level for the second time before we go up. So we are waiting to see price coming down, test this level, then we go up. That level is same as this. This did not even cause any damage, so we will not even draw anything here. We want to see a sign of break. We want to see a structural sign that we're going up. We didn't see any sign yet. Before we join this trade, we want to see a sign, a structural sign that we are going up. We want to see the price form any fractal and break structure and show a sign of going up. Then we'll take a pullback. Otherwise, if we're entering this trade right now, it's not a good decision. Then if you go on higher time frame, you'll see where we are now on the higher time frame. We are right now at this particular order block, which is H1 order block, that is responsible for H1 order block, this one. This order block, this red candle is responsible for this move that went up and broke this high. So if price pulls back into this level here, this one is a sign, is an area of entry. This is an area of entry, but we need to see a bullish engulfing, a morning star around this zone on higher time frame before we decide if we are going up or not. Then if you go again to 4 hours time frame, you will notice that where we are right now on the 4 hours, if you are going from here to here, where we are right now is almost at the middle of the range. The range is from here to here. So where we are right now on 4 hours time frame is almost at the middle. So we have to be very careful. We would prefer to take the trade at the bottom of the discount level, down, deep, not at the middle. So if we are going to be trading from the middle, we have to be very, very careful, right? So with all of this preparation and all of this we have said, we have completely established how we took that trade on the move and how we're expecting to take another trade on the move. Why am I still paying attention to the move? I was on Twitter to see what move was all about. Movement USDT. I saw it on XSpace and I saw that it's an asset that is tech inclined with a lot of AI stuffs added to it. So, and I know that is an asset that we should look out for. Movements. Look at it. Movement. I went through it. I followed them on Instagram. I saw that they have active activity and what is happening. The last post they did was on December 9, and they were talking about Move is now live. This is the big step forward for the Movement network. And what's up? We move. People are commenting. People are saying things. And in fact, they have, is it yellow tick? Or what's it called? There's a blue tick. There's yellow tick. So I think these guys, they are willing to do something massive and crazy. And about 846,000 followers are on this Twitter handle. And I saw some of my guys who are, I know them. They are crypto guys. They are also on this aspect, on this project. So I also saw the way they do their ads. They are serious. So it means that they have volatility. That's what it tells me, that this token is a token that has volatility. And when I went through their post, I saw some exciting stuff that for me is exciting as far as meme coins and altcoins are concerned. So for the aspect of fundamentals and volatility, I was convinced that it's an asset I should watch out for entries, coupled with the fact that we're now in January heading towards Donald Trump inauguration, all of those things put together. So that's a little bit of fundamental. But then back to our main topic for today, which is chart patterns, how to trade chart pattern. The first thing to see is how to trade chart pattern on babypips.com. Time will not permit me to go step by step, bit by bit, as to everything that you need to do. But I've given you access to see chart patterns and to read about it. So if you go further to babypips.com, you will know that chart patterns are like the funny feeling you get in your tummy right before you let a fat explode. So before a fat explode from your stomach, you know you get some funny feeling before it goes out. So chart patterns are similar to those kind of feeling. There are so many things that you will get to know when we start talking about chart pattern, like the list of chart pattern that we are going to cover: double top, double bottom, head and shoulder, inverse head and shoulder, rising and falling wedges, bullish and bearish rectangle, bearish and bullish pennant, triangle, symmetrical ascending and descending triangle. These are the chart patterns we are going to be discussing about very quickly before we go. Starting with a double top chart pattern, I will show you from the diagram. It simply looks like this. When the price rises up and down with red and green candle, forms a top, drop down, but not drop down completely, forms a neckline. You see that thing I always call neckline? You see how it is? Then goes back up again to the same level of the previous one, on its way back to this place. When it gets here, we can now say we have a chart pattern. If the price did not come back to the neckline, we do not have a chart pattern yet. It's a chart pattern forming, but it has not formed a double top yet. We can say this is a double top chart pattern when the neckline is now formed. Like the first move was a move from a low to a high. The second move was a move from the high to the neckline. The third move was a move from the neckline back to the same level of that double top. Then the fourth move must be done back to the next line. At this level, we now say we have a chart pattern. Some people like calling the M pattern. This is a double top pattern. When a double top pattern forms, how do you trade it? We are going to discuss this right now. Now, it's very important for me to also mention that there are different types of double top. Double tops are in several types. This is the regular double top. You may not see this one most often. There are a lot of times you see some of the double tops that are formed, they will form like this. The first one will happen, the second one will happen, the third one will happen, the fourth one will happen like this. So this is also another type of the same pattern. Maybe this drawing is not too perfect, but let me just go a little bit closer to where that thing is. In such a way whereby the top is not straight, it's slant. This is straight, this is straight. Sorry. The top it formed, the place it formed the double top, this one is straight. Sorry, don't mind my drawing, I beg. But this one is slant, kind of. You know, it's slant, kind of. So there is also a type of double top that looks like this. And this one is often in the market. You will see this one more often in the market. This one is there, but you will not always see it. Then there is also another one which looks like this. The move starts, then the first top forms, the neckline forms, the second one goes above. Then the fourth one comes there to the neckline. So this is also another type of double top. But in this case, the tops are not aligning. It's slanting upward. So that is another type. So we can conclusively say that I need to take some breath and drink some water. I mentioned that. What did I say again? Is it conclusively? All right. That we have three typologies of this same thing. So you must open your mind to read or identify which type. Type 1, type 2, type 3. Talking about neckline, the neckline can also be manipulated. Sometimes this neckline cannot be the kind of neckline you see in the drawing. Sometimes they can be very small neckline. Sometimes they can be very deep neckline. That neckline, we use a tool called Fibonacci retracement to measure the neckline. So the neckline formation after the first move, the second move is called a retracement. How deep is a retracement? Sometimes it's 23 Fibonacci, sometimes it's 38 Fibonacci, sometimes it's 50 Fibonacci, sometimes it's 61 Fibonacci, sometimes it's 786 Fibonacci, sometimes it's 886 Fibonacci. So on one of the classes, I will treat Fibonacci retracement. So be rest assured that not all the time you will get, like what I see right here, if this is the bottom and this is the top, this retracement, the first neckline push, is a 50% Fibonacci. So there are different types of retracement. The retracement can be a full one, not full, it can be a deep one, 886, 786, 61, 50, 38, 23. These are the Fibonacci retracement numbers. So one of the class will treat Fibonacci retracement number so you can understand it. So be open-minded to see the drawing look in any form. So, and to remind you about the drawing looking in any form is the structure of a human being. So when I get to head and shoulder, remind me to talk about the structure of a human being. So if you move down here, how to trade it. How to trade the double top pattern is the fact that after this move is formed, this neckline is formed, second move is formed, third move is formed. Now we have the structure. The last one says that when there is a breakout here, after the breakout, you look for an entry. Remember, this pattern, you want to see it H4. I beg, this pattern, you want to deal with it H4. Then you will come down to a smaller time frame after the breakout of the neckline. Neckline open and close of the neckline candle is important. A break of the neckline is important. Then you go down to smaller time frame, look for a pullback of that neckline. That is where you look for your entry from. If you look for your entry after the pullback, you drop the price down to the same level where the move started from. The move started from here, the swing low. The move went here, the swing high. Created a neckline, went back to form the second leg, came down here and broke this neckline. You look for your entry after the neckline. You drop down your trade down to the starting point where it came from. That's your target. So your target will become here, TP. Then your stop loss will be half of the neckline. Half of the neckline, yes. Half of the, yeah, we call this place neck. Is it neckline or what is it called? I've forgotten the name of this. Half of this range here becomes your SL. Your SL is here. SL is here. Your TP is around here. Your entry is around here based on break and retest. That's break, create a new low. Then you find your entry with the entry pattern. You know, I taught you entry strategy, lower time frame. But then you find your entry here. Entry is here. Your stop loss is halfway here. So you look for a structure. Probably this pin back can be your SL in NS. Then you look for a TP here. Now your TP will now be looking like SL to TP is this size, entry to SL is this size, and then entry to TP is this size. So you have something that looks like 1:2 from this particular structure or from this particular pattern. This is very, very important. So if you know this very well, we can use this to trade the move because the move broke the neckline now. So we can use this pattern to trade the move because it's currently happening right now on the move USDT. So I'm going to close this. So I think I'm done with that. So I will show you more and more in-depth stuff you need to know about that. The double top pattern is also a trend reversal formation, but this time we are looking to go. The double bottom pattern is also a trend reversal formation, but this time we are looking to go long instead of short. The one I showed you earlier was a double top. This one I'm showing now is a double bottom, mama and papa. The papa first form. Once the mama form, we are ready to go. So the movement is mama and papa. The first one, the papa first form, put in bum for ground, first bottom. Papa go up, stop at neckline. Remember, the price came from top and drop at the bottom. So that means the price must go back to where it came through. Abi, the bottom was formed. Papa dropped his bottom. He went up, stop halfway, neckline. We marked the neckline. He came down again. Mama dropped her own bottom. So we now have the papa and the mama. The papa and the mama formed. Then the mama must move the price back to the neckline. This is where we broke on move USDT. So after mama has broken this price, now please, when I say break, there's something that is missing here. I don't know why baby peeps did this thing like this. Textbook can be wrong. This break we are talking about is not a break of neckline. This is not a proper break of neckline. It's a wrong one. If you walk like this, you will not get this right. A proper break of neckline is the candle close above the close and open of the last candle on the next line. The candle must break either a green candle or a red candle. In this case, it's actually a green candle. You want to see a bullish candle break. In this case, you want to see a green candle break above and close, not the candle feather. I'm not talking about feather. I'm talking about the body of the candle must break and close above the neckline. You must see that. If you don't see that, we don't have a break of neckline. We need to see a break of neckline, then a pullback, a bullish engulfing, an entry signal on lower time frame. But on this higher time frame, H4, we must see a break of the neckline with a candle body close. Very important. So once that happens, then we now go down to smaller time frame, look for our entry, and we go. When we look for our entry around this zone, which is okay, our entry area, then our stop loss is halfway of that range. This mama and this entry area and this neckline, half of it is going to be our stop loss area. Under this structure, we can use this one as a structure. Our SL is here. Then our take profit is this top that started the move to the downside. So it will be our TP. The price can go more than that place, but it's going to be a break and retest continuation kind of entry again. So, but just know that that's where your TP is supposed to be. Based on this pattern, this is how to trade with this pattern. So that's why I say when you come to H4, you are looking for patterns. This is how to trade the pattern. Then if you move further here, you see what I said. The first move came down here. The second one went to the neckline. In this case now, they are drawing the neckline as that feather. I want you to draw it at this body because the banks will not use feather. The banks will use the body. The body represents those lines that you see, the line chart that you see. So this feather, I don't know, they came from China by one man that is a rice farmer. I've forgotten his name. That's what is his name. So he's just there. So he's the one that introduced all those feather, those noise in the markets. And if you pay attention to those noise, you blow a lot of accounts. So you need to pay attention to the candle body close because that's where the lines, the bank lines are residents at that candle body close. So which is why, again, I also like to use the lines to do my mapping and my lines and my zonings before I proceed into checking the candle. The candle has a lot of distraction that will make you decide wrongly. So remember I said, even if it's a tiny candle body close above that close of candle, it's very, very okay. That neckline is very, very okay for you. If you see a strong one, very good. After the break of this, like in this case, this is a good break of structure. Even the feather was broken, and then the price pull back into a discount level. Then that discount level become our entry level. We'll go down to smaller time frame and look for entry from there. M15, M30. If we do that, our stop loss is halfway of this range. So our stop loss is here. Then our take profit is the full move to the very top. Now, in the case whereby you don't see the very top or there is no top, the easiest way to know what the move will be is to measure from the neckline down to the base. Take that same measurement. If the measurement is 200 pips, take that same measurement and put from the entry to where you want to make your take profits. So the same size of the from the bottom to the neckline, use the same size from the entry to the take profits. But your stop loss will be halfway. So that means you have something mostly like 1:2. So you are risking half of the move to make a full same move, because a proper W pattern, a proper double bottom must deliver a full move like this. So if this is your neckline, this is your starting point, and then this is your stop loss. Then the take profits, this is your entry. The take profit will be the same size from the bottom to the top. If it's 100 pips, the same size from the entry to the take profit will give you 100 pips. That is how to trade the pattern, double bottom. I'm sure I'm communicating. I'm sure you are getting what I'm saying. Please, if you are with me, if it's making sense, I want you to go to the chat box and write double bottom. For me, I like to trade double bottom than double tops. Reason being that the market has a tendency of rising in terms of the crypto. So I want my mind, my psychology to always be looking for buys. And also on the side of the USD, I love to trade GBP, USD. And then also another important pair is USD CHF. I'll be buying, in GBP USD, it's not more of like I'm buying there. I can say more of like I am just paying more attention to the USD. So mostly for future traders, I'll say I like to prefer any pattern that is telling me to buy. I like to look for it. I like to pay attention. The next one I want to quickly look at, our time is fast spent, is how to trade head and shoulder. I want to check if people are putting double bottom on the chat box. And at this point, I would like to slow down a little bit. Those of you watching us from YouTube, it's important that I let you know that my new book is available. My new book is out. I didn't talk about this last year because I was still putting so many things inside the book. I have summarized the entire market, everything you need to know. I've summarized it into 21 pages. Amazing work. Each page of that book is 1 day of training. So people really undervalue the importance of training. People pay less attention to training, but they pay a lot to investments. And I think this is the reason why a lot of people are being scammed. This is the reason why a lot of people are losing their account, blowing their account. They pay a lot of value to investing than in training. I prefer to train and pay $5,000 and trade with $100 or $1,000. Let me just say $1,000. Than for me to train with $1,000 and trade with $5,000. Let me tell you what happens when you train with a high amount. The commitment of whoever is running that training will be high, because the value in exchange for the training is not cheap. My son yesterday was telling me that in his class, he didn't know what he told me was what he didn't say. He said, in my class, Daddy, my friend, he called the name of his friend. I don't want to mention the name. He said, that my friend that was born in America, so name, he mentioned his name. And he now said what he wanted to say. He said in America, they used to go to pet shop where they used to buy, and there's a pet shop where they used to buy cats. That we needed to go to America so that we'll go to the pet shop and buy cats. We need to buy cats and bring to our house. So he didn't know that he already told me that in his class, there are people that were born in America that are telling him what happens in America. That was the message I got. But he felt he was telling me that there's a pet shop in America. So I had to tell him that not only America, even in Abuja here, we have a pet shop where we can go and buy cats. We don't need to travel to America to buy cats from pet shop in America. However, the information I got from him was that in his class, there is a particular guy, he mentioned the name, that was born in America, that always come and give him news and story of what is happening in America. Real life data. So now they are on break. The guy has traveled to America. He told me where they live. He told me what they do and all of those things. I say, is that true? How I wish in my own time I had a classmate that was living in America telling me what exactly is happening in America. My classmate in secondary school was living in Jos. So every time in the class, he'll be telling me about Jos. In Jos, James, by the way, his name is Kasim Mati. Maybe he's watching this video. Kasim Mati will always tell me, James, in Jos, there's a market called Terminus Market. There's a woman that is on that roundabout, a very big woman. That market is like this. That market, he was describing the whole of Jos to me. Do you know what he did to me? He programmed my mind. Since after that, we finished from school, Command Secondary School, Ibadan Cantonment, I wanted to go to Jos. I wanted to go to Jos. I wanted to go to Jos. Why? Because Kasim programmed Jos in my mind. So I read a book and I saw the great Terminus Market inside that English project. You were using this in GSS 3. So they already programmed my mind. Sorry that I'm digressing. That I have to go to Jos. So do you know what happened after I graduated from secondary school? I went to Jos. I looked for money. It was only transport to go to Jos. I didn't have the one to come back. But I had to go to Jos to go and, satisfy that curiosity. So I'm digressing all of this just to, bring all of you back at home. I see you are too committed to the double bottom. I want to distract you a little bit and bring you back. So now I'm saying that these classes are important. Trainings are important. You attend to trainings, you pay a lot of money to go for these trainings, and you get a lot of value. Like me paying a lot of money for school fees, and you can see the kind of value added to the kind of school that I'm paying for. You won't get that value if you didn't pay that amount of school fees. You will get a lesser value. You'll be hearing stories of what is happening in Shangotedo or Zaramaganda. And that is exactly what his mind will be, my son's mind will be programmed towards those things that you already hear. You become what you hear. So because I pay a lot of money, he's now hearing about Paris. He has a classmate that lives in Paris. He has another one that lives in America. He has another one that lives in UK. So many expatriates, their children are there in his class. Governors and other. So because of the kind of money I pay, I would have paid a very small amount of money for him to be in one small school somewhere, and they will learn the same curriculum, the same thing, but the values are different. So with all of this, I'm saying all of this to tell you that my book is expensive. The book is only 21 pages. Guess how much the price is? DM me to know the price. It's very crazily expensive. And each page of that book is a full 1-day training for 2 hours. That's why it's expensive. So you buying the book, you have automatically bought the training. For you buying my book, you have automatically gotten a free account, a prop firm, a free account, a normal broker, a free account on 2 exchanges, Mexi Exchange and Binges Exchange. You get 2 free accounts, broker account, prop firm account, 2 free exchanges, futures and sports for free. You are not paying for any accounts. I'm the one to pay for you. And then you have the book. And then you have each 1 day is a one-on-one training on that book. So at the end of the day, you have the book. It's like you have an instruction manual where you are going to. And I bid you farewell. So, and it's better people pay for such services than for you to just, just go and read Forex on YouTube, go and read Forex on Baby Pips and come back. It doesn't come with any value apart from information that is given you. Here, it comes with mentorship. So those of you that they are suggesting to me what the price should be. Maybe we are going to increase the price or reduce the price. I don't know. But the book is available. That's all I'm saying. So if you want to get access to my book, you reach out to me on the link under this website. You will get access to the book. And then we can take it up from there. So with that being said, we'll get back to class. Double top, double bottom. Head and shoulder pattern. The head and shoulder pattern from the name. I'll start from the head and shoulder. The head and shoulder pattern from the name. The support or the swing low is is marked, you mark a particular place as swing low. Then the price moves up to form a high. That high is called the first shoulder. Then the price comes down to stop at a neckline. Then the price goes up to form a higher top, higher than the first one, number one. Number two is higher than number one. Then the price comes down and stop at another neckline. Usually, sometimes it's straight, sometimes it's slant, it can take different formats. And this is where I will tell you the structure. I'll tell you about structure that I wanted to say. Then it takes another dive again to form another shoulder, which in this time around, number 3 is lower than number 2. Number 2 is the highest. You know where you see Olympic medalists, the bronze, the gold, and the silver. You know they are not of the same height. The middle one is the gold, is the one that is sitting on the highest stage. Then the other two can be staying on either the same equal balance or slanted balance, but the middle one is the highest. That's the formation. But my main point of head and shoulder is that after number 3 has been formed, the price must come down and close below, break the neckline. What we mean by neckline, the most important line that the price must break is open and close of this zone. This level is the most important area you must mark. This level, when you mark it and you draw it, it must align with the neckline with anything here, either feather or body. It must align with anything here, which is where the price took off from. If you are able to draw and achieve a line like this and price breaks that line, candle body close, then what you have is called the structure of head and shoulder. First move, second move, third, second top, third move, this way, this way. This is also head and shoulder. Sorry, I didn't. First move, second move, third one, second move rather, stop this way, went up, stop here. This is also a head and shoulder pattern. But then this connection has to be made. This and this has to be made like this. This is important. This is important, and we drag it down to wherever it's coming from, and there should be something here. You should see something here. It's very important. When that is formed like that, a break of this particular neckline, a break of this place, especially like this, a break of this place, retest of that place is now your entry. We're going down to where it all started from here. Take profit is here. So the entry is here. The stop loss is the break of some people use this place as a stop loss, number 3. Some people go here and look for other block here and make this place SL, the head. Whichever one, it depends on the structure you have. Some people use this one, number 3, shoulder. That's the right shoulder. Some people use the head as a stop loss, but it depends on what structure you have. So you don't have the structure of the stop loss far away from the entry. So if this is entry and the stop loss, either this right shoulder or the head, if it's not far away, it's fine. But the TP is far away, very good. So you can give the stop loss some breathing space. So let me show you what I mean by that. What I simply mean is that the price drops like this. So the distance from the shoulder to the entry. Now, the take profit again, if you can't find where the price started from, you can measure the neckline from the head down to the neckline. Use the same measurement this side. That would give you the distance from your entry to your take profit. Remember that you need to see a break of candle, a pullback, then you look for your entry after the pullback on a smaller time frame. And remember that you want to see this pattern happen where? On 4 hours time frame. Very, very important. Very, very important. So let's go further. We'll discuss. You can read about all these other ones. When I was coming up in markets, I had to draw these patterns, print them out, and put them in my room and be looking at it every morning because I want them imprinted in my mind so that when I go to the market and I see them, it's easy for me to identify the patterns. One thing is knowing the pattern. Another thing is identifying the pattern. The third thing is trading the pattern. So I'm doing the 3 of them for you. showing you the pattern, identifying the pattern, and showing you how to trade the pattern. So in this case, is the fourth pattern, the inverted head and shoulder. The price drop from a height, forms a first shoulder, forms a neckline, forms a head, which is the lowest one, just an inversion, forms a neckline, comes down, forms a second shoulder. Then this time around, we want to see the price break and close above with a bullish candle. Bullish candle, you know this inverted? We want to see a bullish candle close above the neckline. When that is done, we want to have a pullback on a smaller time frame. Then from that smaller time frame, we want to have our entry around this place here. Then we shoot to the top. The height of TP where we are going is determined by the height from neckline to the head. So we want to measure how many pips, what the distance between the neckline and the head. That same distance is what we expect when the price picks up. That same distance should take us to the take profits. All right, ladies and gentlemen, we have less than 10 minutes to round up this class. My timekeeper has just told me my time is up. So, okay, then the next thing here is the playout. Exactly what I explained. Now, in this case, you see we're able to get a valid break of neckline here in the second movement. The first move, neckline form. Second move, head form. Third move, break of neckline. Fourth move, pullback, coincidentally become the shoulder. Then some people enter from the second shoulder. It's very, very important. But this has to only be done when there is a break of neckline from this move. So when you have a structure form like this, it's a head and shoulder pattern. The first move form, the first bottom sets. Second move form, neckline sets. Third move form, head form. The next move form, break of the neckline form. The pullback form, 50% Fibonacci, 61% Fibonacci, 68%, 78% Fibonacci, 86% Fibonacci, whichever one, doesn't matter. But when it forms, we look for entry, morning star candle, bullish engulfing. Some people enter from the neckline here, entry point here. SL is under the head. Then their take profit will be, first take profit is neckline here, 1. Second take profit is the same movement from neckline all the way to the top as the same movement from neckline to the head to give us the TP2 here. So that will be entry point, TP2, entry point, SL. That will be giving us 1:2. So head and shoulder, inverted head and shoulder is good for giving us 1:2. Double top, double bottom is good for giving us, head and shoulder is good for giving us 1:3. Because if you enter at the second shoulder, you are going for 1:3. Why double top is good for giving us 1:2? Because your entry is usually at the neckline. So you go, is 1:2 you get. So which is to say that the head and shoulder pattern gives you more probability for profitability than the double top pattern. That's indication what you see here. So you have an entry at the second shoulder. You have another entry again at the neckline, which is a break of the neckline, any pullback. Like now, sometimes, I've said this, sometimes when you have a proper break of this head and shoulder, second shoulder, you don't have a pullback. Sometimes you don't have a pullback. This is why it's advisable to find an entry on the second shoulder. But when you have a pullback, be grateful for it. Your entry is here and your take profit is the same level as the same entry as from entry to head, the same level from entry to take profits. So you measure your take profit. Usually it's 1:2. Your stop loss is 50% of, no, sorry. Your stop loss is not 50%. Your stop loss is under the shoulder. If you enter at neckline, entry is here. Stop loss is under the shoulder. Take profit is the same level between stop loss, between entry and the head, the lowest low here, the same entry and take profits. So that will be giving you 1:2. That will be giving you 1:2. I'm sure that is very clear. Ladies and gentlemen, that is the head and shoulder pattern. So I want somebody to go to the chat box and write head and shoulder. Type head and shoulder. So we have two types, head and shoulder itself, then inverted head and shoulder. All these other ones, the rising wedge, the falling wedge, they are the same thing. is where you are able to mark the candles, where you are able to mark the candles like this and like this. And you have support, 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 rejection, resistance, 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 rejection. And it's forming this high like this. It's called rising wedge. Me, I used to call it rising wedge. When it happens like that, we usually expect the breakout to the downside to the same level as this. That's the expectation of this pattern. It's saying that the price is trying to go up, but anytime it tries to go up, they are bringing it down. They will get tired and they will break, the price will break and it will come down. That's how these patterns behave. So, and when you see it happen like this, you are not going to jump in for a sell because it gathered like this. You can keep gathering and going like this until you take your SL out. You don't know when it will end. So you are going to wait until you see a breakout happen first. When the breakout happen first, then you will wait to see a pullback on a smaller time frame. Remember, when you have a breakout, you will mark that breakout candle. Then you go and look for a pullback. The pullback can be 23% Fibonacci, 38% Fibonacci, 50% Fibonacci, 68% Fibonacci, 61.8% Fibonacci, 78.6, 886. I will talk about Fibonacci retracement in our next class tomorrow. So the retracement can be any Fibonacci level, it doesn't matter. The retracement can even go back to the line where it broke out to, it doesn't matter. But when you see a retracement on the smaller time frame, first you must see a breakout on the bigger time frame H4. It means the rising wedge is now falling. It's now dropping. And the drop is the same size of the wedge from the beginning. You draw the wedge from here, check the same size. That's the same size of the final drop. So after the pullback, you look for your entry. Your stop loss is at the end of the wedge. Your stop loss is at the end of the wedge here. Your entry is after the pullback, depending on which pullback you get. Your entry is here. Then your take profit, SL, is here. Your take profit is the same size of the wedge. It's the same size of your take profits. So that is it about the rising wedge. Inverse of it is called the what's it called? The bearish continuation signal. This is bearish continuation signal. Yeah, rising wedge, bearish continuation signal. I think I like this type. I like this type. It's a rising wedge that forms after a price was coming down, then begin to form rising wedge. This rising wedge is part of pullback. So when it forms to usually like half of this particular move, and then we see a break to the downside, is a very, very strong indication that we are going down. So this is the kind of rising wedge I prefer. My stop loss is at the top of the wedge when I see the breakout. After I see a pullback on a smaller time frame, then I look for entry in the pullback. I taught you how to look for entry. You drop this price as low as the same size from here to here. You bring it down, it's going to be from here down to here, something like this. So there'll be your TP, this will be your entry, this will be your SL. So that is it about the rising wedge. We are using it to sell this position. Look at what I just finished saying right now. Then if we go, we have the falling wedge. The falling wedge is the inverse. When we have the price dropping like this, why is this guy not picking up? It dropped like this first move. It go up. It come down, give us a type 2W pattern. It go up. It couldn't go below. It couldn't go to neckline. It still come down again. Going up and down, up and down, up and down. What is happening is a falling wedge pattern that is forming. When a falling wedge pattern forms, what you want to see is a breakout candle, H4, breakout candle, bullish one. When you see that, you want to have a little bit pullback. Usually the pullback is around 38%, sometimes middle, 50%. Then you want to see a reason to enter. Smaller time frame, M15. You go all the way to the top. The same size of the falling wedge when it started forming. The same size from entry to take profits. Your stop loss is under the wedge. The lowest low of that place is your stop loss. Of that formation, that structure is your stop loss. So you go like that. The same thing I've just said, that's it here. Now, the best kind of falling wedge, I like to trade, which is this one. You should not joke with this one. We are in the bull run. You want to see this kind of falling wedge form on all the cryptos, on Bitcoin and Ethereum, Solana, Cardano, Move. This is the kind of falling wedge you want to see. Anytime you see a rising move in any crypto, on 4 hours time frame, you want to see the price begin to drop in kind of chart pattern. When the price drop in terms of chart pattern in a falling wedge pattern like this, all you are looking for is a break of that wedge. The wedge from first touch, second touch, third touch, fourth touch, fifth touch, any number of touch doesn't matter. But you want to see a bullish candle break the wedge. Once a bullish candle break the wedge, you want to go down to smaller time frame, look for entry at 50% Fibonacci, M15 or M30, look for a bullish engulfing at that place. That's your entry. You go all the way to the top. The same level you have in the wedge, the same level you have from entry to take profits. The same, then the stop loss is directly the lowest low that formed in that wedge. The lowest low you are forming that wedge is your stop loss. So this is how to trade the falling wedge, the best way to trade the falling wedge. And the best falling wedge that gives you the high probability, this particular one, not the other ones. This particular one gives you the high probability falling wedge. This is what I've just said. When we have the wedge form, you want to see a proper breakout of that wedge. When the breakout happens, H4 time frame. Don't forget, H4 time frame. Go down to lower time frame. You now study pullback based on Fibonacci retracement. Minimum or the pullback you always want to work with is the breakout block one, the one that comes to 50% of that move. The move that is responsible for the breakout, the 50% of that move is where you expect the pullback to come to. Limit order, mostly you use rising wedge like this. Use limit order to trade it. You pick the entry from that place and usually it goes. And when it goes like that, that's all. Somebody go to the chat box and type rising wedge, rising wedge, rising wedge, rising wedge, rising wedge. My time is up, ladies and gentlemen. It's now time for us to draw the curtain and go and ask people to go and identify rising wedge, falling wedge, head and shoulder, support, head and shoulder, which one again? Double top, double bottom. This one is similar to double top, double bottom, but it's a situation where we have a rectangle. The price refused to break out of this rectangle. It's called a box. It's called a range. It's called until we see candle break with a bullish candle. Then we go down to smaller time frame, pull back, trade, look for the pullback, enter. When we enter this, our stop loss is the middle of that range. Then our entry is after the breakout, the pullback entry is here. Then the take profit is the same size of this range, the same size after the breakout. That's our take profits. We are gone. So this one usually give us a 1:1 most of the time when I see it happen. It's not a very, it's not a high probability. No, it's not a high profitable chart pattern. So it's usually used by scalpers. So when the price is in the box. So when it eventually breaks, just measure the box. That is where we are going after the breakout. But you need to see a pullback. So look at this. It forms like this, especially when price is dropping. Then it ranges and break to the downside and pull back. When it breaks to the downside, this is the break. This is the pullback. This is the bearish engulfing. Maybe I need to say this. This is the break I noticed. This particular one is the break, not this one. This is the break. This is the pullback. Pullback is also a topic I need to teach you on one of the days. What is a valid pullback? A valid pullback is important. It's important you know when there is a pullback and when there is no pullback. So this is a break. This candle broke. This particular candle that break and form this new low. If there is no candle that pierces above that candle, it means there is no pullback. So here we have all this particular candle goes and pierces above this candle that caused the break. That makes this a valid pullback. After a valid pullback, we are looking for bearish engulfing. Now we have a bearish engulfing 4 hours or 1 hour time frame. Then we enter from here. We take it down to the same size of the range, the same size of take profits. The chart pattern is completed. Any other thing you are trading after the chart pattern is completed is your own structure or your own trend or any other thing apart from chart pattern. This one is the one where we want to look at for because we are in the bull run. Price is moving to the upside. We'll see price shooting to the top in Bitcoin and Ethereum. How do you jump in? When it moves up, you see price begin to stall or range or form a rectangle. You wait for the rectangle to be broken to the upside. You look for pullback. Then you find your entry. Your stop loss is middle way that range. Then your entry is after the pullback, a good entry strategy. Then your take profit is the same size as what we have just explained right here. This is the break. Then you go and look for entry from a smaller time frame. 23 Fibonacci, 50 Fibonacci is good. You will see an entry, and then you go all the way to the top the same size is your take profit. If it keeps going, it's an extra for you. TP2 and trailing stop. Ladies and gentlemen, go and put ranging. The range is the same as rectangle, so the rectangle pattern. The rectangle pattern. So we have how to trade bullish and bearish and bullish pennants. Pennants is the same as this. You can see the way it looks like. The same thing. Look at see the way it looks like. It's very tiny and small, but we're looking for a breakout. Brief consolidation. The consolidation is not much. Then we see the breakout to this downside. Then we look for entry and we go in. Bullish pennant. It's pushed up this way. Then the consolidation is not much. Then we see a breakout. After the breakout, we find the entry. We are gone. Pennant. I don't really like that chart pattern because it's confusing. It's very tricky. That's why the name is not also popular. Then this other one, symmetrical triangle. This one is also very tricky and confusing. So it's not facing up, it's not facing down, it's called symmetrical. When it happens like this, it can break this direction, it can break that direction. So it's very, very tricky. You must be sure that you have a valid pullback and a valid breakout and a valid pullback. And a strong breakout at that is important before you take this kind of signal. Then this is ascending triangle. It's also very tricky. That's why you don't hear the name a lot. It goes in ascending format, and then this one is ranging. We usually allow it to, we usually want to see it break to the downside, but it can also break to the upside though. So you just watch out for breakout, then a pullback, then you enter, and then you go like that. Look at this one, it's descending triangle. The same thing, we want to see a pullback usually to the upside, and then we take it. I don't really like these patterns because they are confusing. They can go in either direction and they can mess you up. So after the breakout, but make sure you get a strong breakout and a valid pullback of 50% Fibonacci, then you enter, and then you put your stop loss very tight, then you go with it. So you move on, we take that, we move to the next lesson. The next lesson is mostly telling us about three main groups of chart patterns: the reversal chart patterns, double top, double bottom, head and shoulder patterns, inverse head and shoulder pattern, rising wedge and falling wedge. These are, we covered these patterns already. You can remember these patterns that we covered: the double top, the double bottom. If you want to take a screenshot, this is where you take a screenshot. All that we have said, this is what you have to remember. For me, the most important for me is this one. This is the most important for me because of the bull run and what we are facing right now in the markets. So this is continuation of chart pattern. These ones are the ones I say I don't pay attention to. This one, they are confusing. They can cause problems for you. Falling wedge, bullish rectangle, bearish pennant, rising wedge, bearish rectangle, bearish pennant. I don't really care about them because they can be confusing. This one, ascending triangle, descending triangle, symmetrical triangle, they can really lead you to a lot of damages. So I don't really pay so much attention to them. But please, if you can master them and learn them and use them, then that will be your own edge. Some traders use them. My friend Larson Lino like using all those things. So chart patterns, form, uptrend, type of signal, next move. I think I told you this, so you don't need to cram all this one. Time for quiz. Start the quiz. What are the reasonable place to put your stop loss when trading chart patterns? Don't use stop loss. 1 pip away from your entry price at the middle of the original formation. This one. Correct. Next answer. Next question. In the chart patterns, this chart pattern is very similar to the, This chart pattern is very similar to the rectangle. It usually occurs when sellers or buyers pause to gather enough energy to take price back to the same direction. The shape that price forms after downtrend. The shape that price forms after the downtrend or uptrend is a small rectangle. I think I will go with the wedge. Incorrect. You see, I told you that wedge, pennants, and all those things, they are confusing. See, it has just confused me. When price breaks out when price breaks out to the upside in a bullish rectangle, The move up is usually 1/2 the size of the rectangle, about the same size of the rectangle, twice the size of the rectangle, the same size of the rectangle. Remember, I told you this is correct. Next question. What you call the chart pattern that is formed? What do you call the chart pattern that is formed when a valley is formed? Valley. Followed by even lower valley and another valley equal to the first valley in a downtrend. I don't understand this question. Falling wedge.
Inverse head and shoulders.
Inverse head and shoulder. No, I think it's falling wedge. Incorrect. Inverse head and shoulder. Okay. I understand now. I think you are correct. Inverse head and shoulder. Don't mind me. What do you call chart patterns that signal that the ongoing trend will likely resume? Continuation, reversal, bilateral is called continuation. Correct. In a head and shoulder pattern, the distance price move after the break is usually equal to half the size of the head, a distance from the high point of the head to the neckline, the distance from the high point of the shoulder to the neckline. Who will tell me the answer? Who will tell us the answer, please? Nobody?
It's the third one.
No.
See?
The distance from the high point of the shoulder to the neckline.
The distance from the high point of the shoulder
From the edge to the neckline.
The distance from the highest point, the distance from the highest point of the shoulder to the neck, the distance from the high point of the shoulder to the neckline, the distance from the high point of the head.
Yeah, I think distance from the high point of the shoulder to the neckline.
Oh, it's from the head.
Distance from the high point of the head to the neck.
From the head, not the shoulder. Correct.
You want to
Which type of chart pattern forms when price consolidates between an upward support line and a downward resistance line? What's the answer?
Wedge.
The first one. Correct. Which pattern is formed when price consolidates into a box after downtrend, indicating sellers probably need to pause and catch their breath before taking their pair any lower? Rectangle. The key word is rectangle. What they are saying here, consolidate in a box. Bearish rectangle. Yes or no?
No.
I will choose bearish rectangle. I'm correct. I'm done. We're doing tests, please. What does bilateral mean when talking about chart patterns? I didn't read about that. It means that there is no bias as to where price is headed. The breakout can be either up or down. Yes or no?
Yes.
Correct. Oh, very nice. You got 7 out of 9. So, share your. This is exciting. So, every one of you on this call, I need you to go and take a test on chart pattern and subsequent classes. Drop it in the group. We have a group for, please mute your mic, I'm hearing myself. We have a group for traders page. I want you to go to traders page and take a test. Any of the topic we have done, take a test. and submit your results of that test in the group so that we will see that you are serious, you are writing the test, and you are getting your score. So that is like a certificate of all the things we have studied. Go to babypips.com, check out for anything that we have studied, and take a test. Send your results to the groups, especially the traders page. You see what I'm doing? I'm sharing my results to all the group that I have. So I want you all to share your results with the traders page so that I will see that you are a serious person. That's the assignment for every one of you on this call. Even those of you on YouTube, you can as well send me your results. My link and the group link is right there at the description level. So we have come to the end of this class. We are 26 minutes behind schedule. I'm so sorry about that. Tomorrow, we are going to be looking into retracements. How is retracement measured? It's measured by the tool called the Fibonacci retracement tool. What is a valid retracement and what is an invalid retracement? So I'm going to be treating the topic, say, how to trade Fibonacci retracements. How to trade with Fibonacci retracement. So when we identify a Fibonacci retracement, how do we trade with it? So we are going to be looking at this topic tomorrow. What is a valid retracement? What is an invalid retracement in a move? So permit me also to tell everyone on this call that my book is out. 2025, my book is out. And my book is titled The Complete... Let me find the title again. I've forgotten the title of my book. My book is titled The Complete Training and Mentorship Mastery, a 21 days Forex and crypto training. The book has 21 pages. It comes with so many goodies, values attached to the book. Each one day of that book is a food class. I'm going to give you that class by myself. So the group book is not everywhere yet. Before we take that book on Amazon to be selling it, we would have trained nothing less than 21 people. Then we'll put the book on Amazon. Because once the book is on Amazon, anybody that buys the book must be trained. And I may not be the one to do the training. Any of you that buy the book, that do the training, you are the one to be getting that commission for training that person. So I'm going to be getting mentees for you. When people buy my book, you buy the book and people buy the book after you. You are the one to train them and you get the bonus. And the bonus is $1,000. When you train anybody that buys my book, you get $1,000. So the book is going on Amazon before the ending of this year. But before the book goes on Amazon, I must have trained 21 people. Because these 21 people, they are the ones to train the people who are buying from Amazon. And when you train anybody on that book, after you have been trained from that book, you get $1,000. So that's an amazing business. Just training people from a book and you get $1,000. So if you are just watching on YouTube, you want to go and get that book, reach out to me to get the book. The book's already out. It came out yesterday. And let me shock you, somebody already bought the book. And let me remind you, the book is very expensive. Very expensive. Very expensive. So don't even chat me if you know you are not ready for what I mean by very expensive. Don't chat me. It's not for you. So just stay on YouTube and be getting the free YouTube videos. And I wish you best of luck with all the free YouTube videos. Now I have come to the end of this class, exactly 8:30. So we continue tomorrow with the topic we have for tomorrow. If you have any question, please reach out to me on the general VIP traders page. Reach out to me so I can be able to answer your question. And with that, apart from that, I